Today, what the ETF? Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and property news with a distinctively Australian flavour. Well, the Bitcoin bulls are racing again. A year ago, the cryptocurrency was valued at around $12,000 US. Now it's past the symbolic milestone of $60,000 US and is in fact nudging higher. Bitcoin's rally over the past month is largely attributed to speculation the US Securities and Exchange Commission is poised to approve an exchange-traded fund, or ETF, based on Bitcoin futures. In fact, Bloomberg received a listing action from Valkyrie Funds for their Bitcoin futures exchange-traded fund, and this ETF will be trading very soon under the symbol BTF. And in fact, new information from Bloomberg indicates it might start trading on Wednesday or Thursday. A post-effective prospectus filing with the US Securities and Exchange Commission is the last piece of the puzzle missing for listing confirmation. Valkyrie likely exploited its status as a first-time issuer to skip the queue by requesting to become effective. And Valkyrie could join ProShares and have their Bitcoin futures ETF starting to trade this week. ProShares also confirmed that its Bitcoin strategy ETF would begin trading very soon, and the fund will trade under the ticker BITO and seeks to provide institutional retail investors with Bitcoin exposure. Although the ProShares ETF is already set to go live, Valkyrie still needs to publish a post-effective prospectus filing with the SEC. However, neither the ProShares Bitcoin Strategy ETF nor the Valkyrie Bitcoin Strategy ETF will hold actual Bitcoin. Instead, they will seek to obtain Bitcoin exposure through Bitcoin futures contracts, which significantly affects investors. A true Bitcoin ETF, which would hold actual Bitcoin, still seems a far-fetched reality in the US. In any case, investors are encouraged and incentivized to take ownership of their Bitcoin exposure by investing in Bitcoin directly. To invest in any asset through an ETF means to take the easier route, as it's more straightforward for those accustomed to trading in the stock market. However, it introduces attack vectors that could and should be avoided. Investors will only be able to take advantage of Bitcoin's true value proposition of censorship-resistant and sovereign digital money if they choose to purchase and self-custody Bitcoins themselves. The easier route might be attractive for enabling people to get exposure to Bitcoin right away and switch to self-custody as they learn more about Bitcoin, but relying purely on an ETF for Bitcoin exposure will likely prove to be reckless in the long run. But it's also worth asking, so what is an ETF? And why does this matter in the value of Bitcoin? And The Conversation actually published a very good article on this. An exchange-traded fund is an investment fund comprising a pool of assets traded on a stock exchange. The general attraction is that an ETF offers individual investors the benefits of diversification, protection, and liquidity. Suppose, for example, you wanted to invest $100,000 in commercial property. You can't afford to buy an office building or a shopping centre by yourself, and even if you could, buying just one building will be putting all your eggs in one basket. And here's where a funds manager with an ETF can help. The manager buys a number of office buildings and shopping centres across a range of locations. Suppose those assets cost $100 million. Those are then bundled into a fund with 1,000 units sold for $100,000 each. It's like buying a share in a company. It allows you, the investor, to avoid the exposure that comes from buying a single asset. Instead, you get a share of a diversified portfolio. If the value of the portfolio rises, so does the value of a unit. And if you want your money to liquidate your asset by selling it, that's easy to do because the fund's units are traded on an exchange. And an ETF is also regulated. This protects you from some of the risks, such as fraud, that come from buying assets directly. Rather than physical assets, as In our example, many ETFs hold securities such as stocks and bonds or derivatives. These funds can be either passively or actively managed. Passively managed funds, which are the most prevalent, hold a basket of assets that track the market or a market segment. An index fund, for example, holds shares in proportion to their weight in a stock market index, such as the S&P 500. If the company makes up 5% of the index value, the manager will ensure its shares make up 5% of the fund. Actively managed funds, by contrast, hold more shares whose price the fund manager expects to rise strongly, and fewer or no shares they expect to perform poorly. Whether the return on these funds exceeds those delivered by passive funds depends on whether the fund's manager's judgment or luck is better than that of the market as a whole. So what's all this got to do with Bitcoin then? Well, a Bitcoin traded ETF is seen as something which will entice more investors to gamble on the cryptocurrency. Buying Bitcoin or other cryptocurrencies directly can be fraught. Forget your private key, that's the equivalent of a password or PIN, and you lose it all. There is no friendly local bank manager who can retrieve or reset a password or make good your loss. Scams are also on the rise. In the US alone, more than 81,000 cases of fraud were reported in 2020, and similar patterns were also seen elsewhere in the world. In 2020, there were 9,689 crypto crimes reported in Australia, compared to 0 in 2016. And in the UK last year, 8,801 crypto-related crimes got reported. That's up from 704 in 2016. While these figures are startling, they don't take into account all the scams and theft that involve cryptocurrencies that did not get reported. Sometimes people are too embarrassed to admit that they may have been duped or that they saw their crypto account hacked. If these non-reported crimes got added into the data, then the level of crime involving digital currencies would no doubt be a lot higher. So bundling up cryptocurrencies into products overseen by traditional funds managers and regulators can be seen to have advantages, bringing greater respectability to cryptocurrency trading, so long as you aren't bothered by that being the antithesis of the decentralized and distributed ideals that drove tecto-libertarians to create cryptocurrencies in the first place. But while investing in cryptocurrencies through an ETF brings a number of safeguards, it does not reduce the market risk. An indirect gamble is still a gamble. Indeed, an ETF of Bitcoin futures isn't even indirect ownership of a pool of Bitcoins. It's a pool of contracts about bets on the future price of the cryptocurrency. If this sounds a bit like the complicated derivatives known as collateralized debt obligations that led to the global financial crisis in 2008, you'd be absolutely right. The more complex the financial instruments become, the more dangerous they may be. One of the few who predicted the collapse of that market was hedge fund manager Michael Burry, portrayed by Christian Bale in the 2015 movie The Big Short. Last week, he effectively warned that cryptocurrencies are a speculative bubble. This is a view shared by most economists and business leaders. As with all bubbles, some will make fortunes, but many will lose, so it's important to take care. The potential widening of the crypto investor base hasn't gone unnoticed among Bitcoin bulls, though. Current trading action in derivative markets suggests that traders believe the popular cryptocurrency will not only advance to eclipse its prior record high, but also top $100,000 by year's end. The favoured options contract on Bitcoin appears to be call options with strike prices above $100,000, expiring at the end of the year, according to Glassnode in its weekly on-chain report. The open interest in call options dwarfs that in put options, aligning with the overall bullish market sentiment. Ahead of the launch of the futures-based ETF, heated debate continues on whether a futures-based ETF is the most suitable investment vehicle to drive up crypto adoption. Some argue as a Bitcoin futures exchange-traded fund doesn't directly hold or own Bitcoin, but rather Bitcoin futures, it won't do a very good job of tracking the price of Bitcoin, potentially leading to underperformance. Simeon Heyman, global investment strategist at ProShares, however, downplayed the risk. There's a lot of evidence from experts that the futures market, if anything, is a better place for price discovery, he said. The CME futures market is a regulated place and actually trades more volume than the largest US crypto exchange. For all the bullish speculation, however, there is one group of investors that needs to hold onto their crypto to keep the bull run alive, and they're the long-term holders. These long-term holders, or LTH, are starting to show signs of itchy fingers to cash in profits. With about 98% of Bitcoin still held as an unrealized profit, a meaningful jump in traders cashing in or realizing their profit could take the wind out of Bitcoin's sails. Over the past week, we can see a slight softening of the LTH net position change metric. This suggests a degree of LTH spending is occurring as prices rally above 60,000 US, Glassnode added. For the moment, however, there is enough demand to keep dip buying healthy. Whilst we have now confirmed that profitable coins are on the move, these metrics indicate that current demand is sufficient to absorb any sell-side pressure applied, Glassnode added. So standing back, I want to highlight again that ETFs are not necessarily a silver bullet when it comes to Bitcoin, particularly as they're aligned to the Bitcoin futures, and particularly because there is really no way of understanding what the fair value of it is. And the argument that the futures market is somehow a better price discovery market is, well, rubbish, I'm afraid. Sure, there is a greater volume of transactions in futures markets. That's because people are taking multiple positions and hedging one off against the other. And in fact, futures markets do impact current prices. But of course, a lot of futures contracts are never taken to completion. They're used as a speculative venture. So in a way, what we're seeing here is the continued mainstreaming of Bitcoin, so that effectively more and more financial engineers are now starting to play the same games in crypto land as they did some time back in other financial markets. And I want to leave you with this thought, because a few months ago I discussed this with Adam Stokes, and I made the point that we should understand that crypto is now becoming contaminated with all of these mainstream behaviors. So the concept that crypto is in some way distinct and different and clean and unregulated and therefore free is a pipe dream. It's becoming mainstream, and as it becomes more mainstream, it's going precisely the same way as the other sectors of the market. So, as always with these things, buyers need to beware. I don't think the Bitcoin ETFs are anyway a silver bullet. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.